It's time to start. Thank you for attending. I'm Chris Menard. This webinar is sponsored by the University of Georgia, Terry College of Business. We're going to run through some financial ratios. If you have any questions, just use the Q&A box. So let me get started here. I'm going to share my screen. Okay, the first group of ratios I'm going to run through, I have over 19 to do, and I've got good news. I'm not doing 19. I'm going to cover some of the big ones, but I decided to break this up by doing balance sheet ratios first, then some income statement ratios, and then some that are based on both financial statements. And then at some point also we'll look at a couple actual companies after we go through here. So I have the balance sheet running. If you recall from the last webinar, whether you're with me or not, assets equal liabilities plus owner's equity. So I have 62,000 in assets in C19. If you look down at C39, I've got 62,000. But within our assets, we have current assets. Those are assets that should be converted to cash within 1 year or used up within 1 year. And so I've listed some very popular ones here. I even threw out prepaid expenses. An example, in case you're wondering, I told you last time, whenever you see the word expense, it's always going to be on an income statement. This is one time it's not. Let's say I want to pay my homeowner's insurance for the year up front because I save money. That would be a prepaid expense. And then every month I would take that amount and divide it by 12. So that is an asset. It's called a prepaid expense. So the first one we have is technically not a ratio, but it's something you need to know. It is called working capital. And I even put next to it what I'm going to do. I'm going to take my current assets and I'm going to subtract my current liabilities, which you can see down here. So that is debt that I owe within the next 1 year. So that's just going to be simply equals our current assets minus total current liabilities. To be honest with you, hopefully this is always a positive number. If it's a negative number, you don't have the money to cover your current liabilities, and therefore I got $6,000. The next one I'm going to do actually ties into it. So this is our first ratio. This is a very popular ratio for the balance sheet. I'm going to take our current assets and I'm going to simply divide by the current liabilities. Again, there is no magic number to these. A lot of these ratios are based on what type of industry you're in. So a food and beverage industry may have completely different ratios than a manufacturing company, for example, or a utility company, or even a bank. So this is going to be equals 25,000, and I'm just simply dividing by the current liabilities. And again, ideally, you're going to get at least 1 or over. I'm going to show you Microsoft's financials in a second. They have the number 3 there. So they have 3 times the assets as they do of the liabilities. So as I mentioned, again, it's based on your industry. I noticed, I was looking around today, I noticed that Costco had a 0.8 at one time, and so did the Disney company. They were at 0.9, which means they had more liabilities than they did assets, but those companies are well established, so that wouldn't bother me any at all. The next ratio is actually one of my favorite, very similar to the current. And I made myself a note before I show you the quick ratio, back on this current, let me show you something, and I've got a question for you. So let me use my hyperlink here. So I have 2 companies listed, Company A and Company B. I have 6 years of data for both companies and assume that they're in the same industry. If you notice in 2019, over in column G, they both end up being 1, meaning the assets, the current assets equal the current liabilities. But if you had to pick between these two companies, let me change this question. If you're worried about one of these companies, what company would you be worried about? So let me throw this poll question up for you. The question is, which company do you prefer? And I'm going to launch the poll. There you go. If you would, I'll give you 10 seconds. Just pick one. And I can't see anyone's name. This is going to be interesting. There is no right or wrong answer. All righty. I'm going to end it and share the results. There you go. I'm going to stop sharing. No right or wrong answer, but if it was me, it's actually company B I'll be a little bit worried about. I'll show you why. If I highlight this data, and I'm just going to insert a line chart. So I went to the Insert tab, line chart. I just don't like the way that they keep trending down. Or if I can find my line chart, it's probably right in front of me. There we go. Pick that one. So if you notice company B, which is the red line, they just keep somewhat going down except for this little bump they had here in 2016. Company A seems to be steadily getting better. But again, that's just one ratio of many, so you just can't look at just that one. But anyway, that's just something to look at. Back to my balance sheet. One other item I want to point out about these ratios is just because a ratio may be bad at some point in time, because remember, the balance sheet is at a very specific point in time. I'm in December 31st, 2020 in this example. Next month, I could have a ratio of 2.6. So that's why you sometimes have to look at both the industry you're in and historically what you've been doing. Before I continue, does anyone have any questions? I do have one already. The question is, you'll send us these worksheets, correct? The answer is yes. I'll go ahead and tell you that, but I'll also type in yes, or apparently I can't type in yes. Well, also on my agenda is after this webinar is over, I need to learn how to use this Q&A box, but the answer is yes, Robin. So oh, by the way, I'm glad you actually brought that up. I'm still sharing my screen. Let me pull this over for you. I've noticed I got one typo on it for sure. I made this web page for you. Copy. I'm throwing it in the chat box right now. There you go. If you scroll down, there's a few videos. I haven't done any on the ratios yet, but I do want to show you this. Financial ratios related to the balance sheet. This is where I'm at right now, showing you what to do and why you would do it. So then after that, I'm going to jump into the income statement ones, which are actually, these are actually pretty easy. And then finally, there's 4 more. And again, I'm not doing them all, where I have to do the balance sheet, pull something from the balance sheet and pull something from the income statement. So I made this page for you today. So there's that. Any more questions before I continue? Here we go. All right. The next one, so we did the current ratio. The next ratio is actually one of my favorites. It is the quick ratio. So again, it's my current assets and my current liabilities. But what I'm going to do here, for my current assets, I'm only going to use cash, accounts receivable, and if I had any short-term investments, I'm going to use those, but I'm not using inventory and I'm not using any prepaid expenses. And the reason is this. Inventory, my inventory is only going to go down when people buy stuff. And then if they buy it on credit, then I got to invoice them, and we may be in a net 30 terms, and then I got to collect the money. So I just want to know quickly, can I cover my liabilities? So that's why it's called the quick ratio. So this one's going to be the sum right there, even though I don't have any short-term investments, I would include them, divided by the total current liabilities. And there you go. Because inventory sometimes takes a while to turn into cash. And I told you already, those prepaid expenses, that $1,000, if I got to do it every month, 1,000 divided by 12 is the answer on that one. So that's going to take a little while. The next one is the debt ratio. So this time we're going to take the total liabilities and divide it by the total assets. So let's go ahead and do it first. So my total liabilities are current liabilities and my long-term. Don't tell me I didn't total them all up. There it is, total long-term. So it's this number plus that number. And we're going to divide it by our total assets, which is 62,000. And there's your answer, 0.35. That basically says 35% of my assets actually belong to creditors. That is what that number is telling you. So obviously, to be honest with you, just in general, the higher these two numbers are that I just put in yellow, the better. But now the lower the 0.35 is, the better. So hypothetically, I'm just making this up. Remember, assets equal liability plus owner's equity. Hypothetically, if you had no owner's equity and your assets equaled your total liabilities, you would have the number one, and you'd probably be in trouble, to be honest with you, if you had no owner's equity. So the lower the number, the better. And then finally, the last one is the debt to equity ratio, and it's the liabilities divided by the owner's equity. I'm just going to do the math in my head. 19,000 and 3,000 is 22,000 divided by 40,000. So equals 22,000 divided by 40,000. In real life, don't do this, reference the cells. But there you go on that one. That's telling you if the shareholders had to fund the company because they got to pay for the liabilities, could they do it? And the answer is yes on this one. So, any questions before I continue? I do have one. Yes, the answer, I will record this. I believe I already am. Let me just check. And I tell you what, if I'm not, I'll go back and record. Yeah, I'll tell you what, I know you can't see it, but my screen says pause recording. I know you can't see that. And it also says stop recording, which means it is recording. So the answer is yes. Okay. So we just ran through technically 4 ratios, and then we just figured out what's called the working capital. So real quick review, the working capital and the current ratio are actually tied in together. One is math and one is division, but you get that. Quick ratio, I'm not counting my inventory, I'm not counting prepaid stuff. And then the other two had to do with owner's equity and total assets and total liabilities. And that is all listed on my website. So now, let's go jump. This part's actually really easy. Let's go and jump to some income statement ratios. I will pull this over for you just to show you where I'm at. Gross margin, profit margin, also called sometimes net margin, and then I'm going to do the earnings per share. So I'm just going to do 3 here. And there's one on here I didn't put that I wish I would have, and I'll go back and add it. It is called the operating margin, so I'll add that 2 here. We did this at the last webinar. I think if you recall, I did vertical analysis. So some of this is actually vertical analysis. But your gross margin is simply, before I do the gross margin, You have gross margin, but you also have something called gross profit. Gross profit is your revenue minus your cost of goods sold. Think about a car manufacturer. When you go purchase that car, cost of goods sold is all the direct costs that went into that car. So that would be all the direct labor. If they had an assembly line, it would be the material for that car. It would also include any storage fees for that car, but would not include advertising and stuff like that. So it's cost directly associated. That's cost of goods sold, which gives us over in cell A7 the gross profit. And so I've got revenue of 480, cost of goods sold of 460. There's my gross profit. So your gross margin is the gross profit simply divided by the revenue. That is going to be a percentage, 46%. The higher that number, the better. Your profit margin is your net income, which is down in cell C21. Done. So let me do that one real quick. That is going to be equals the net income divided by the revenue. By the way, just to tell you this about revenue, so I'm around 10%. There you go. Just leave it at 10. When it comes to revenue, you always take away, whether you know it or not, you should always take away any returns and allowances. So if I had total revenue of 500,000 and I had 12,000 in returns, people just shipping stuff back, they didn't like it, I would deduct that from the 500,000, the 12,000, plus I would deduct the 8,000 for allowances. An allowance is when you buy something, you want it, but you realize, oh, this is somewhat defective, but it's not enough for me to return it. You call them and they say, hey, we'll take 100 off the bill or 200. That would be an allowance. So that is technically net revenue. There you go. In between these, between the gross margin and the profit margin, the one I didn't show is called your operating margin, and it's your operating income divided by, again, the revenue. The operating income includes, so the cost of goods sold subtracted from the revenue will give you your gross profit. But then I've got all these other expenses, selling expense, R&D, advertising. This includes all that stuff. If you think about it, web hosting, marketing, all that falls under operating. So it's going to be equals the 54,000 divided by, again, C5. And that is another number that you should always look at, because let's say you're keeping your actual costs for your products in line, but all of a sudden, I'm making this up, you spend in R&D twice what you were spending, and then you go on, start hiring a bunch of people. That is when your operating income and your operating margin is going to start going down. So, and before we move on, just to show you this, let me do a little pause here. Anyone have any questions before I continue? I'm assuming you're still there. Just nod if you are. Don't nod, I can't see you. If someone would chat in the box, that would make me feel better. Still around, anybody? Or ask a question so I know you're here. Thank you. I appreciate it. I am going to, I just grabbed these right before class. Oh, by the way, so I've been looking at financials all day, getting ready for this. And I happened to pull up Apple's financial, and this just blew me away. Apple had cash, I believe it was last year, Q3, on the financials, $258 billion in cash. I was like, okay, that's a lot of cash. So anyway, here's Microsoft's earning release, FY19 quarter 3. So again, assets, they broke out current assets, cash, short-term investments, accounts receivable. I'm just showing you a few things here. There's their total current right there, 159. I'm not going to say that whole number, 159. So if I took their current assets and divided by their current liabilities, which is right here where I'm slowly moving the mouse, 53,000. So they're sitting pretty with the current ratio. They're also sitting nicely with the quick access ratio because they don't have much inventory anyway. So before I do this, before I run into this next one, I want to show you back on their income statement. So I'm jumping around just for a second. So now we're looking at their income statement. There's their gross revenue. There's total revenue, cost of revenue. Cost of revenue also is cost of goods sold. So there it is right there. Then there you go. There's that gross margin. I called it gross profit. I do see gross margin in here, but again, the ratio is the same. And then we get into our operating expenses, R&D, sales and marketing, G&A, and there's that operating income, again, what I just showed you too. And then we end up with net income. So where I'm headed is this. I want to show you how these earnings per share, because this is another ratio that companies are always talking about. Earnings per share is your net income divided by your outstanding shares of common stock. That's usually found over on the balance sheet, or it could be in a very specific area of the financials. So let me pull that one back up because I don't have any common stock listed here. Let's see if we can't get the right answer. So our net income is 8809, and the amount of common stock, weighted average outstanding common stock. Notice it says basic and it says diluted. I'm only going to work on basic now, and I'll tell you what diluted is in 1 second. If I take 8809 and divide by the amount of outstanding common stock, 7672, I should get 1.15. Let's see if that's true. I'll leave this up on the screen just so I don't have to keep moving it away. Yep, I told you I'd leave it on the screen, but I guess I lied. Here we go. There we go, right over here. So you take your net income, 8809, you divide by the amount of outstanding common stock. So it's that number divided by that. I should get 1.15. There you go, 1.148. And the diluted is the same thing. In case you're wondering what's the difference between common stock and diluted stock, we have common stock, we have preferred stock. There's some preferred stock that can be converted to common stock, and that's why we have two different numbers. We have the basic and the diluted for earnings per share. So they can decide if they want to show you if they bought back, if that preferred stock became common stock. That's all they're showing you. So earnings per share is net income divided by the average amount of common stock outstanding. In case you're saying, what is the average amount of common stock outstanding? I'm gonna scroll to the top on this. Let me maximize these real quick. They come up with that. So this is quarter 3 for Microsoft. So what they did is they took the common stock that they had at the beginning of the quarter, and then they took the common stock they had at the end, they added them together and divided by 2. Basically, they're just getting the average. That is how they figure out what's the average common stock that's outstanding. Because companies can always sell stock and they can also buy back stock. So that is your earnings per share, which is right there. And there is a typo, and that will drive me crazy. So I won't look at it then. All right. By the way, looking at Microsoft's financial statement, FY19 quarter 3, I pulled up FY19 quarter 2. This was a press release they sent out. I just want to, let me see if I can increase the zoom on this. That better? I think it is. Okay. I just wanted to show you something real quick. There's their revenue, but I showed you there's their operating income. So now you know, okay, there's revenue, operating income. I can go get the operating margin percentage. There's their net income and diluted earnings per share again. So EPS is a big number. The higher the EPS, the better. So anyone have any questions before I continue? We have about another 5 to 10 minutes and we will be done. So let me pull this over back to Microsoft Excel. So there are your margins right there. Let me show you where we're at on my list. Financial ratios related to the balance sheet and the income statement. Account receivable turnover. Let's go figure this out. This is net, okay, this one's interesting. It's net credit sales for the year divided by the average accounts receivable for the year. So the average accounts receivable for the year, if I was doing the year 2019, I would look at what is my AR on 12/31/2018 and what's my AR on 12/31/2019. And again, I would average those. And then this is the one that's tricky. To figure out what your net credit sales are for the year, most companies do not, on their financials, they'll just tell you what their revenue was. I just showed you Microsoft's. Apple did the same. Dell does the same. So it's almost like you have to either read in the footnotes if they put it, or it may be an internal number because I want to know how quickly our AR is being turned over. So let me just show you how this works. So assume that I know that I had 500,000 in net credit sales. So I would take the 500,000 and I forgot what that other number was. The accounts receivable average 42,000. In case you're wondering, just to be clear, the reason you don't take the total is when I'm dealing with accounts receivable, if someone's paying me cash, that's not going to go to AR. Cash would get debited and revenue would get credited. So that's why it is only the credit sales divided by the AR. So we're turning over our AR 11.90 times. The higher the number in general, the better. So this ratio right here, just by itself is good, but there's another one that goes with it, and this. So we turn it over, our accounts receivable gets turned over 11.9 times. What that means is this: there's 365 days in a year. So now if I take that 365, let's say your terms are net 30, and I divide it by the average number of times we're turning over the accounts receivable. Basically every 30.6 days, we're getting paid on average. So if our terms were net 30, we're pretty good right here. But here's another example. So let's say, I told I'm gonna keep this one here so you can see it. I'll copy and paste it. So example 2, let's say that instead of 500, this is 385,000. That number just dropped down to 9.16. I told you the higher the number in general, the better. So that means we're turning our accounts receivable over 9 times a year, 365 days divided by the 9.16. So now we're getting paid almost every 40 days, but our terms are net 30. That would be something to look at. So that's why these financial ratios are pretty cool. So what I did for you on my website is I did the accounts receivable turnover, and then I immediately followed up with the second part that I just did. the days in accounts receivable, and you can see where I got that 30.67. I'm not going to do it, but you can do the same thing with inventory right here. Notice again, the reason it's two financial statements, I would take the cost of goods sold, which is on your income statement, and I'll divide by the inventory, which is a current asset on your balance sheet. And again, the last two tie into each other. It's how quickly you're turning over your inventory. Anyone have any questions or comments? Hey, do y'all recall when I actually was in person, did I show y'all how to do a contribution margin income statement? Does anyone remember that? Yes. The URL. Yeah, I'll put somebody's chatting in the box, just so you know. So you do have access to my website. I will put it again right here, right now. There's the website page that I was referencing. I will upload this file to the website, and I'll go ahead and tell you where I'm going to put it because I haven't put it up here yet. I've got to change that date to something else I missed. So I'll change that date. I'll put it right up here. It'll say Excel file, say financial ratios or something. And then after you get it, you can start going through these whenever you want to. Anyone else, chat or Q&A? I'm happy if you are happy, Mark. Thank you. I appreciate that. It's very nice. If you need help with any other accounting stuff, I know you have accounting classes, but I also know you're an Executive MBA program, so it's pretty fast. I know it's fast paced. So if y'all need ever like, hey, Chris, can you do some more accounting stuff in Excel? That's up my alley. Just let me know. I know Lauren says as much as y'all can get. Super fast paced. Okay, slow it down, then I will next time. I do have this recorded though. So you want to see any of them again, or you good? I'm good if you're good. Thank you all. All right, I'm gonna wrap up. I appreciate it. Everyone have a great evening. Yeah, and by the way, I've got the recording for the last one too. I'll make sure Lauren's okay with it, then I'll post that too. Can you do our assignments for us? What's that guy's name? Is it Elliot? Is there an Elliot? he didn't ask me to do the assignment, but he sent me something. So no, I can't do your assignments. I appreciate it though. Where will I post the videos? I will post the videos. Here you go. Another great question. Just see, I like to keep everything nice and tidy. So I'm going to post the video on my YouTube channel because it's just easy to post on YouTube. But right here, some videos you might find helpful. I will put it, you'll end up with a fifth one here. How about that? Will that work? Sounds good to me. So everything will be on my website, but the video will be on YouTube. But all you have to do is honestly just click it and then click YouTube or maximize, it'll play. So have a good one. Hope to see you again soon. Thank you.